Hello, everybody. Today I'm joined with Beppy, and we wanted to address something that has shocked the world of D2C. Unilever is rumored to acquire Wild in a 230 million pound deal. And what makes this deal so fascinating is that we haven't really had that many acquisitions in the past few years since the D2C bubble erupted. And now we're going back to those old days of crazy acquisitions. So we wanted to spend some time really tearing down Wild's P&L for 2023 and 2022, unpacking some of the insights and giving our thoughts about why exactly Unilever is putting so much money on the table. So without further ado, Beppy, maybe let's dive into the report.
That sounds good, Val. It looks like the good times are back with these sort of valuations.
That's for sure.
Yeah. Cool. So yeah, like we said, last week it was announced that Unilever are going to potentially go ahead with this deal at £230 million. I think it's worth kind of caveating a few things here, Val, because I don't want anyone to think we've got any connection to either company. So we've never worked with Unilever or Wild. All the information we've got is publicly available on Companies House. We have made a number of assumptions, kind of based on our experience working with 7- and 8-figure D2C brands. But yeah, this is purely for entertainment purposes and in no way kind of investment advice.
Of course, but we are going to share more detailed breakdown as well on top of this video, which is a bit of a lead magnet that we'll release later in the week so that you can see a full detailed analysis and also understand our thoughts about the situation, how exactly to build a business worth an exit from Unilever.
Yeah, it is super exciting. I think we both work with similar enough businesses. They're at a kind of level that Wild would have been at maybe kind of last year or the year before. So this kind of definitely gives you something to aim for if you're running a similar sort of business.
Absolutely. Well, maybe let's go through the history of this business, right? How did they get started?
Yeah, so they were incorporated towards the back end of 2018. So 6 years from incorporation to exit, which I think is super impressive. To kind of go from nothing to a £240 million exit is fantastic. And hats off to the founders, Freddie and Charlie, for that.
Absolutely.
Yeah, so Wild was UK's first plastic-free refillable deodorant. So they're really going after that sustainability niche within a kind of massive industry. They raised between 10 and 11 million in total. Yeah, and as we mentioned, founded by kind of Freddie and Charlie. Both have previous experience at D2C brands, so HelloFresh and Climate Cup. And they built a omni-channel presence, which I think is super important for that valuation, which we'll touch on in a bit more detail.
Absolutely. And just a couple of points to point out as well. I think it stands out that, first of all, they really jumped onto the D2C opportunity right before the bubble, exploded, right? So they started at the right time to build this business. The second thing is they identified a specific problem in the industry. And they also had the relationships potentially, because we've got two founders who have experience, right? So they might have had some partnerships or relationships in this specific category or industry to actually connect to Unilever before they even considered exiting, right? So they knew that there was a problem. They knew that it could be a very lucrative problem to build around and potentially an exit. And that's something that a lot of investors and fundraisers talk about. If you want to have a roadmap for an exit, you should start with building a clear path to the exit. Typically, a lot of bigger corporations want to acquire brands that solve a specific problem that they struggle with. And instead of investing money in research and development and building internal teams, they would rather outsource that research and development to another company that will do it for a few years and then kind of acquire them, because that's the easier path for a lot of corporations. Just put some money on the table, don't waste time, right? And then acquire when they're ready. And I think that's the exact situation that is happening with Wild. What do you think, Beppy?
Yeah, absolutely. And I think this is one of the key drivers for the valuation. I think we'll probably go into a bit more detail, but yeah, it's they've turned something that we all use and we're probably inadvertently using on a subscription basis without actually signing up to a subscription. So I like to think we both probably use deodorant every day, Val.
Yep.
But typically I'd go to my supermarket or chemist and I'd buy my deodorant. So I wouldn't be signing up to a direct debit. So traditionally it was all done on kind of a wholesale basis, and then the consumer would go to their local outlet to purchase it. But yeah, I think what Wild have probably done very well is driving that direct subscription model. So for the first time ever, people are going onto a website, they're signing up on direct debit, they're getting their deodorant delivered to their house. And I mean, the benefits of that are pretty obvious, but it means it's almost guaranteed revenue. Of course, people are going to drop off on the subscription, but they probably have a good idea of what that looks like in terms of churn. So they can go into the following month or the following year knowing they've kind of banked maybe 50% of their revenue from the previous year already.
Yeah, and even though we made assumptions about their marketing, I think it's clear that they're pretty efficient in terms of acquiring customers and retaining them, because otherwise it would have shown much higher numbers on the P&L in the operating expenses or general administrative costs, right? And one more thing that I wanted to note as well is that this is a win-win for both the consumer and the supplier and back-end sort of supply chain logistics space, because again, it's a subscription model that is helpful for the consumer, but it's not pushy enough. And on the flip side, it's a refillable deodorant, right? Which solves the problem of waste and recycling. So it's a very attractive opportunity in the space to capitalize on. And I think they've done a great job doing that at the right time.
Yeah, absolutely. So before we go on kind of what we think drove such a high valuation, Val, or if we did actually think it was a high valuation, let's go through a couple of the assumptions we made and kind of why we've made those and talk through that in a bit more detail. So obviously the P&L that's available on Companies House only shows certain line items. So it obviously shows revenue, shows cost of goods sold, which is the statutory definition of COGS. So that's a landed cost of products. It's not including outbound shipping, payment processor fees. So that's why we've kind of made those assumptions above. You can find the salary costs within the P&L, depreciation and interest. So you've got an idea of EBITDA. And yeah, the assumptions we've made. So for outbound shipping costs, we've assumed 6% of revenue. We had a bit of a debate about this before the call, Val, because you thought that was a little bit on the lower side, and I kind of agree with you in hindsight. My kind of assumption was a lot of it would be wholesale, where the shipping costs are a lower percentage of revenue, but yeah, it's probably a couple of percentage points too low. That
for sure, yeah. And we don't have the exact split of wholesale versus D2C, and that's what we kind of talked about previously, them being an omni-channel business, right? But depending on what kind of average order value they have and the repeat customers as well coming back and how much they're exactly spending, do they add more products on top of their subscription? We don't have all those insights. It would be interesting to have that data. But 6% on $100 makes sense, right? It would be about 6, or on 100 pounds, it would be around 6 pounds, which kind of makes sense. But if their average order value is actually lower, then we could be pushing a much higher percentage of shipping costs as a percent of revenue. But if wholesale steps in and it has a huge chunk of their business, then of course that would push the shipping cost down, because they would probably freight the goods, which is a little bit more efficient than shipping every single parcel, right? So 6% is a very good kind of range, but it could be as high as 8% and as low as 5%, right? So it's in that range, but 6% is a good figure.
Yeah, conversely to that, we probably overshot the payment processors. I've gone with, I typically see between 3 and 4%, especially if you're kind of selling abroad and being hit with conversion fees from Shopify, etc. But again, if a big chunk of this is wholesale, they're probably going to get slightly under 3%, but it's probably within that ballpark.
Yeah, it's still a good range to aim for. Again, like you said, if they have a lot of currency exchange fees, that would be priced into their transaction fees, and it could be very high as well. I have some clients who pay 4.5%, 5% on international transactions, right? So depending on how much they do internationally, wholesale, D2C, I think 3% is pretty fair.
Perfect. And then we put in 2% of revenue for software, which that probably scales quite well. I'd imagine that will go down as the business increases revenue.
Absolutely. And I would also say it depends on how much of that is fixed versus variable. For example, if they include Klaviyo fees, again, if they use Klaviyo for their retention, right, or Yotpol for their retention, then of course that could be much higher, since they're very subscription-based or subscription-driven, which means that there's a lot of emails probably going out, right, to retain those subscriptions. So it could be a huge chunk depending on how big their list is, how many customers they have. So it could be much higher than 2%, but I would probably imagine it's in the range of 1%. But of course, on the back end, could be a lot of enterprise solutions like Oracle or NetSuite, which are very costly and can add up to a lot of dollars on a monthly basis. So 2% is pretty fair, but again, it could go either way as well.
Perfect. So yeah, let's jump into it, Val. So we think if they've managed to double revenue between 2023 and 2024, obviously the data is available as at the end of 23. Unilever paid between a 2.5 and 3.5 times revenue for Wild. I think you were quite shocked, Val. You thought that was quite a high valuation. So yeah, keen to hear your thoughts on that in a bit more detail.
Absolutely. I mean, gone are the days of crazy acquisitions on revenue, right? And 230 million pound valuation for Wild, assuming double growth in 2024, that would mean 2.5, 3.5, like you said, Beppe. And that's a crazy number to me, right? And of course, there has to be more at play in the background that we don't know about. And I think it goes back to what I mentioned about building for an exit. There might have been some synergies that were already in place before they even scale to 10 million pounds in revenue. And now as they grow, they're proving the concept, they're proving the roadmap that they laid out. And Unilever, seeing the results, seeing the problem being solved for them, could actually pay much higher premium because it's worth to them specifically, right? Again, we're not saying that 2.5 and 3.5 are valid valuations on revenue right now, especially if you're not profitable. This is not possible, right? You can at best get 1x if you're not profitable, at best, right? This is your best case scenario. If you're profitable, 1.5, 2, best case scenario, 2.5, 3.5, assuming double growth. That's crazy, right? So if they don't double growth in 2024, it means even higher multiple on revenue, right? Which is insane. So there has to be much more going on. And again, based on the numbers that we are projecting as well, and you can see the full analysis for the projections for 2024 in a separate lead magnet that we're going to share with you. You will see that 20x EBITDA is the expected multiple on that double growth, assuming all of those ratios for profit, right, on the P&L. 20x is also pretty insane EBITDA because we're seeing 5x to 7x for a lot of low 8-figure businesses. But again, there has to be something else going on, right, Beppe? What are your thoughts here?
Yeah, exactly. I think it is punchy, and they've done a great job to get that valuation. But I think once we've gone through the reasons why, I think it makes a lot more sense. And I think Unilever have made, it's obviously strategically the right move for them in their opinion. But I think they made a bit of a gamble, which is justified based on kind of the projections and the markets that Wild have managed to penetrate. But yeah, let's go through all of those points now, Val. Of course, we touched on the first one, I think. So they successfully penetrated a niche market where I imagine, I don't know, but Unilever have probably struggled. There's a big growth in sustainable brands. And I think the kind of brand Wild have built is a pretty cool brand. I think a more established company like Unilever may struggle to build a similar sort of brand. So strategically, I think from that perspective, it makes a lot of sense.
Absolutely. Yeah, couldn't agree more. And I think I've talked about it enough.
Yeah. We touched on it earlier, but an extremely strong subscription model. We don't know what % of their revenue comes from subscriptions, but it would have to be quite fundamental for somebody to move away from their deodorant. If you're anything like me, you've been using Lynx Africa your whole life. So I think if someone's using Wild, they're probably going to stick with Wild, which makes it very easy to it makes it a formulaic growth, doesn't it? You've got a very good understanding of the lifetime value of a customer. You know how much you can afford to acquire each customer, and then how much contribution you're going to be making over the next probably 1, 2, 3, 4, 5 years from that customer as well. So I think that's definitely true. I think if this wasn't a subscription-based business, they wouldn't be getting anywhere near this valuation.
And yeah, exactly. And that's where cohort analysis comes into play, right? You have to understand your numbers if you're a subscription-based business. You have to know how much it costs you to acquire a customer. When do you recoup that investment? And with a 50% product margin, you can imagine that they probably make very slim margins, if not lose money on the acquisition. But the retention, the retention is extremely strong for them, that they generate enough cash flow and profit with each subsequent purchase from each consumer on the subscription model, and it adds up to huge profits for them overall. And you will see that on the P&L when we show it to you.
Yeah, and it's a good point you make on the margins there, because I actually think the margins, from my experience, are on the lower side. I know there's probably a big wholesale element of this where the margins are obviously naturally going to come down. But yeah, I know kind of cosmetic brands that are much closer to the 80, and I've heard stories of the 90% product margin. So I think that's probably seen as an opportunity for Unilever. They're experts at building these sort of cosmetics products. So although the EBITDA multiple looks quite high because it's quite a low EBITDA, I think Unilever are going to see multiple ways of kind of getting that closer to the 80-90% range for product margin.
That's a really good point, Beppe. I think that's exactly where it's at. If they have those synergies in place and they have their supply chain figured out, taking this brand and boosting the margin could mean even more profit for them, which is much better ROI on the investment and shortens the payback period on that investment. So why not pay a little bit more if you know exactly what you can do with this brand and how you can make it even more profitable?
Yeah, absolutely. So I think the other key points are they've demonstrated growth in high potential markets. So predominantly the US and the EU. So their growth has actually slowed down in the UK. But yeah, I'd hate to admit it, the UK market probably isn't the same powerhouse as it once was. And actually, to drive a valuation like this, you need to show product market fit in the US. So we can only see rest of world revenue, which kind of 3x between 22 and 23. But yeah, I'd kind of bet the majority of that rest of world revenue is coming from the US. The US economy is kind of 8.5 times bigger than the UK. So I think Unilever are probably seeing the opportunity there that if they could do anywhere near as much or take anywhere near as much as a percentage of the US market as they have for the UK, then revenue is going to skyrocket over the next couple of years. And again, they've done very well in the EU as well. The kind of 2.5 revenue between 22 and 23. And then the EU, I mean, it's a bit more fragmented. The EU, obviously, the Polish economy is probably very different to the German economy, but still, as a trading area, it's 5.5 times the UK. So to show significant growth in those two markets is definitely probably driven that multiple valuation.
Absolutely. And I was very surprised to see how much the US represents as a percent of their revenue. It's very tiny, right? You would expect much more. Like the UK and EU is probably doing like more than 80% of their revenue. So can you imagine the opportunity? They probably saw a challenge in the UK and the EU to grow further, right? Of course, it's going to be slowing down, but the US is still such a huge market, that you can tap into and capitalize on that opportunity. And Unilever definitely saw that, and I think they saw an opportunity to expand into the US, reach that growth, multiply the growth, optimize the supply chain for more margin, and overall just boost the bottom line for the brand. And I think that's exactly what's happening here.
Yeah, absolutely. We obviously don't have the 2024 data, but it wouldn't surprise me if they kind of 3x or 4x rest of world revenue in that time, and that really would have attracted Unilever too wild. There's a couple of other points. They've proven scalability. If you look kind of at our breakdown, operating costs as a percentage of revenue is going down. They've gone from loss making to profitable. So everything, all those key indicators are moving in the right direction.
Yeah, they're tapping into economies of scale right now and keeping their operations pretty much intact, not taking too much in form of dividends, and that translates into bigger cash reserves that you will see on the balance sheet. No debt at all, which you've kind of listed as the last point, right? No leverage whatsoever, which reduces the risk for the investor, for the acquirer, and also being the omnichannel presence diversifies the risk for them, right? Being wholesale, being D2C, and Unilever has access to retail, offline retail, right? So they can basically, if need be, bring the product into the stores and thereby grow the revenue even further, right? So I think overall, Unilever is probably eyeing a very lucrative opportunity, and that costs money.
Yeah, definitely. Cool. So yeah, probably let's jump into the P&L, or kind of a P&L summary that we've broken down by margin. It kind of represents a lot of what we've discussed in the call so far.
Yeah. And again, you can see that revenue in the rest of the world is 2.8 million, right, out of 46 million. So it's around, if I'm not mistaken, that's less than 10%, right? That's around 5% maybe, roughly speaking.
Yeah,
So can you imagine
yeah,
the opportunity, right? Then you can see how much growth happened from 2022 to 2023. Huge spike in percentage terms, but not so much in dollar or pound terms, right? So you can imagine that you can easily get to 10 million with Unilever's help in the United States, right? Easily in 1 year, maybe even more than that. So opportunity is huge as long as the supply chain can sustain such huge spike in growth. It's a perfect lineup for Unilever. And overall, you can see how even though United Kingdom is growing, right, double, or actually they doubled and then 50%, so it's slow in percentage, but in pound terms, it's pretty much growing in similar pound terms. So potentially in 2024, we could assume 35 million pounds in the UK, assuming similar pounds being added, but it could be as low as 30, right? Because again, the economy in the UK is not growing, so we're making some assumptions here. But overall, UK is still a huge chunk of their revenue. EU is a big chunk as well. The US is where the opportunity is. So overall, 46 or 47, nearly 47 million pounds is a pretty big business, don't you think, Beppy?
yeah, absolutely. What I think is quite interesting here is they obviously they're UK brands, they started UK. When looking for growth, they went to the EU first over the US. I typically see it the other way around. I think, or brands quite typically start in the UK and they'll look to the US for growth straight away. So I think that's quite an interesting approach they took to go to the EU first. And like I said, I think we added 2024 to this. I think the key winning market would definitely be the rest of the world, which is predominantly US.
Absolutely. And then if we move on to the product margin, which is very interesting, it sits at about 50%. And you can see how they optimize it quite well compared to 2022 and 2021. It used to be 4%, 5% less. Now it's higher. And we don't know exactly what that includes. Of course, the assumption is that based on the requirement, like Beppy mentioned, the statutory requirement, cost of sales represents cost of goods sold, which is everything that you incur to make products ready for sale, which is, uh, costs that you pay to the suppliers, freight, import duties, all of that stuff, right? And of course, the product margin seems to be quite low for a D2C alone brand. For a wholesale business, it makes sense a little bit, right? Because wholesalers typically sell at 40, 50% product margin, maybe even less than that if they focus on volume. So overall, I think it makes sense. But again, we have to dive into the numbers and understand what exactly is happening there. 50% is still strong at volume. And I think that's the goal. It's a volume play. Doesn't apply to a lot of D2C brands that don't have omnichannel presence or don't have scale, right? If you're sub $10 million or pounds, pretty similar. If you're sub 10 million pounds, then you have to focus on being more profitable, right? So understanding how you can squeeze more product margin. And again, ideally you want to go as high as 80%, but of course it depends on the category niche, right? You want to sit at above 60% for sure as a D2C brand when you scale, because you're going to spend a lot of money on marketing. You're going to spend a much higher baseline of operating costs as a percent of your revenue, which will eat into your net profit. And net profit is what you want to generate to be a sustainable business, because you reinvest net profit into further scale. But what do you think, Beppy?
Yeah, I would love to see this P&L broken down by different categories. So if Wild were a client of ours, we'd probably have a D2C P&L, wholesale P&L, maybe new clients versus existing, which is probably more relevant for the other margins. But yeah, I'd like to assume that the direct-to-consumer side of the business, the margins are much higher, and it's actually being dragged down by that wholesale element.
Yeah. And what I'm not worried about is the fact that they have strong retention, right? They probably give up a bit of margin to lure customers in because they know that the LTV is strong and they can recoup those profits as time goes on, right? And if you don't have to rely on financing, you don't need to finance that gap until you turn profit with your customers. So you can sacrifice a bit of margin because you can finance it internally, right? And not worry about mistakes later. What happens with a lot of brands that don't have a solid product or sticky product, right, is they acquire at a very tight margin and then they don't retain for enough periods to basically justify the investment, right? And that's when issues arise. In this situation, and again, you will see the balance sheet, you will know that they have very good and solid cash reserves, which means that they're very good at managing their cash conversion cycle.
Absolutely. So I think we kind of touched on the shipping costs as percentage of revenue and the payment processor fees, which kind of brings us down to the gross margin, which is at 41%. So yeah, definitely getting lower and on the lower side of a kind of a cosmetics-based business. We've derived the marketing costs by basically taking the admin costs from the P&L company's house. We've deducted kind of salary costs, which are freely available, the software where we made assumptions, kind of rents and rates. We put a line in for general. So this is really the number that we're guessing the most here. But from my perspective, it makes a lot of sense. Kind of the spending of the 46 million in revenue they've made, around about 9.5, 10 million are marketing costs. And as a fast growing business, they're probably just trying to acquire as many new customers as possible.
Absolutely. And again, this is all an assumption. The only thing that we know for sure is the salary costs, which is £3 million, right? That's broken down in the report, and you can take a look at that as well. So we know the total operating expenses, right? OPEX. We know the salary costs. We deduct that from there, and the rest is kind of an assumption, right? So we have to draw some conclusions here. And again, like Bepi broke down, the software fees being 2% of revenue, then rent and rates, also an assumption here, right? So we taking those assumptions with a grain of salt, we can assume that their marketing is quite efficient, which right now we're looking at about, if I'm not mistaken, about 20%, right? If we look at gross margin, contribution margin, it's about 20%. It could be slightly higher, let's say 25%, but that means they're more efficient on the back end, right? So if it was 20 to 25%, it's still pretty solid, because if you look at a lot of D2C brands, right, they're doing 30, 35%. And again, part of it is wholesale, which you don't have to have any marketing investment for, right? And part of it is retention, quite strong retention, so they can bring customers back in. So 20% would be very strong. 25% is still quite decent, not as strong as 20%, of course. But if it goes as high as 30%, then of course that's when we can start asking questions, right? Are they that efficient? How much of their revenue is wholesale? Because 30% blended marketing, right, means that D2C is way less efficient on the marketing side, because wholesale kind of blends that, right? So 20% is very strong for this business, if it is the case. But of course, we would need to see the numbers.
Of course. Cool. And then that brings us down to a 2.5 million EBITDA at the end of 2023. That's quite a significant turnaround from a 2 million loss in 2022. Of course, like we said a few times, we've not seen the 2024 numbers, but I'd like to think EBITDA has probably outstripped revenue growth due to those operating efficiencies. Obviously, we don't know. They may have had this exit in mind for quite a while now, and actually it was just about getting the users on board on that subscription model. So maybe they kind of sacrificed EBITDA for that. But yeah, I think overall to get to 2.5 million EBITDA at the end of 23 is quite a good position to be in.
Yeah, I think they made the right decisions at the right time when it was important. And again, you may be wondering, how exactly do they build cash reserves when they lose money for 2 years? And that's a valid question, right? And it's all about cash conversion cycle. You can be losing money, but if you manage your cash conversion cycle quite well, you can still build cash reserves. And we'll talk about that in a more detailed analysis, but we'll touch the balance sheet shortly. But one key point to mention is that you need to figure out a way to have your suppliers finance your inventory. And that's what's going on with Wild, right? They're doing an incredible job of extending their payables as long as possible, as to not rely on any debt which costs money or pay out of their pocket. So they force or put the suppliers into a position or in a partnership that works for both sides. I would assume it is the case. Otherwise, they wouldn't do it, right? So their suppliers actually carry the cost and help finance the inventory that they sell at a tight margin.
Yeah, absolutely. We can just go down to the balance sheet now. But yeah, just to kind of one other bit of data that we do have is average number of employees and revenue. So if you're looking at revenue per employee, which I think is quite a good indication of efficiency, they're getting increasingly efficient over the years as well. So I think this overall kind of paints a picture that a lot of the key KPIs are moving in the correct direction. And again, just touching on the fact they managed to become profitable, which was Yeah, definitely more of a trend after the econ bubble kind of ending. 22, 23 was kind of moved to that profitability. So they've done a great job there.
Absolutely. And just to point out as well, this is not a standard, right? For revenue per employee. It doesn't mean that you should be, at 1 million per employee to be an efficient business. Of course, there's some schools of thought, something that you should be at 1 million per employee, right? But it really depends. If you have to invest right now into building the right team for success in the future, then it takes some money and your revenue per employee goes down, right? So it really depends at what stage you are. Are you at the growth stage or optimization stage when you focus on profit? You have to make decisions based on each individual scenario. That's why it's so important to have the right tools and frameworks in place rather than just follow the standards that everyone spits out in the space.
Yeah, I would agree with that. I see a lot of clients where the revenue per employee is actually quite low. But then as they've scaled, that team has been the core team. And obviously it's increased, but not at the same rate. So that's come down fairly significantly.
Yeah, exactly. Cool. Now the balance sheet, the last piece.
Yeah.
As you can see, guys, the cash is growing, right? Compared to 2022. Of course, 2022 it went down again. Losing money for too long will cost you cash, of course. But you can see that even though they lost money in 2022, they still managed to report strong cash position in 2023. And again, the way to look at the balance sheet is you have the assets, which are your cash, your inventory, your fixed assets, all of those assets, right? And you can see how their stock is growing year over year. But who exactly finances the assets? That's the main question that the balance sheet needs to answer. And if you look at the second section of the balance sheet, and if you could scroll down maybe just a little, you will see that we've got liabilities and equity. Liabilities are instruments or types of financing tools that finance your assets, right? Equity is so basically liabilities are things that you don't own that finance your assets, and equity is things that you own or that you have partners for to finance your assets, right? So it's kind of like internal versus external financing, right? And equity is internal financing versus liabilities being external financing. So in this case, we can see the bank loans being extremely low, right? It's negligible in this case. We've got other provisions, which is something that we would need to investigate what exactly that is, right? But the main financing comes from trade creditors, which is accounts payable, right, in the US. So it's basically your suppliers, your manufacturers waiting for you to pay money, right? So that's supplier financing essentially. And they're doing a great job of that. And that's how they build very good cash reserves and finance their inventory. So again, if you look at stock, 7.3 million, and they've got 8.7 million in trade creditors, right? So actually all of their stock is financed by trade creditors, which is a good thing. And then if you look at the equity side, and if you could scroll down just a little as well, we can see that we've got retained earnings, which is a cumulative profit since inception, right? And of course, it's still negative because the first few years were negative. They were losing money. But then it kind of flipped in 2023, right? Now it's becoming positive. And share capital is how much money they've raised essentially from internal team and outside investors. So that's how much money they got. And we can see an increase of around 3.7 million, right? Would that be correct? 3.7 million, roughly speaking, in share capital, which means that they got some money to help. And that's why their cash position is stronger than it should be, right? But of course, depending on what exactly they do with that money, how efficient they are, what they use it for, do they finance inventory? Do they finance expansion? Do they finance marketing initiatives? It really depends. But in this case, I can see that inventory is financed by creditors, which is solid, right? So they must have used all the raised funds from investors and internal team to fuel growth or expand further.
Yeah, absolutely. I think it's a very strong position to be in, especially cash generating.
Yeah, exactly. I think nothing else from my side on the balance sheet. What do you think, Bepi? Is there something that we should discuss as well?
No, I don't think anything particularly jumps out from the balance sheet perspective. So I think we could probably wrap it up with kind of our closing thoughts, Val. So I think coming into this, we both thought the valuation was a little bit on the punchy side. But kind of going through the analysis and the figures in more detail, what are your closing thoughts? Do you still think it's punchy, or do you think it's actually a bit of a bargain from Unilever?
It's a good question, right? It's look, they're profitable. They're likely operating cash flow generating that, because again, if you're profitable, chances are you're generating profitable cash flow. If you manage your cash conversion cycle well, you're operating cash flow positive. So overall, those two check off. They probably have good intellectual property, or IP on the products that they develop, right? They probably have a good customer base that is loyal and comes back for more product. They probably have robust supply chain that serves both omni-channel, both wholesale and D2C, so they have omni-channel presence. All of those speak very minimal risk. With each point that I just mentioned, there's less and less risk for an investment from Unilever's perspective. So overall, it makes sense for them to put up money. Would I go as high as 230 million? I would need to do due diligence, right? And understand what exactly is going on. Is there a connection between Wild and Unilever? I still think it's too high, right? They might be overpaying, but again, without understanding what the synergies are, how exactly the deal is structured, right? Does the team that is currently on Wild's team join Unilever? Is there more talent that could help with product development for Unilever? What exactly is the deal here, right? Because there's so much at stake, and during the M&As and acquisitions that we don't know. And of course, Unilever, being such a huge conglomerate of brands, can probably afford that, right? To splash some cash. There just has to be a reason for them to do it.
Yeah, I would tend to agree. I think overall, I think it's a great acquisition from Unilever. I think we're looking at the figures in 23. We've made assumptions for 24, but I think if you look down the line at 25, 26, I think revenue is going to probably carry on growing at a similar sort of rate. The business is optimizing as it grows. So I think those multiples come down significantly. And in kind of 3, 4, 5 years' time, we'll see this, in my opinion, as a bit of a bargain. But hopefully it represents the good times been back. And I'd feel really positive if I was a similar sort of 7 or 8 figure D2C or ecom brand. This would give me something to aim for. And it shows that exits are still achievable. And if you're moving in the right direction, you've got the correct KPIs, the correct infrastructure, then people are still willing, or companies are still willing to pay a premium for great brands and great businesses.
Absolutely. And for you to maximize your chances of a successful exit, you got to have the foundation in place, right? Which means accounting, right? And finance. Because when due diligence happens, if there is a lot of things that you don't show correctly, that may raise a lot of red flags. So accounting is the foundation of your exit. So if you guys are in need of a solid accounting firm, Bepis firm is the best I've come across. So you should definitely reach out to them. And of course, there's finance plays, right? You got to optimize your numbers. You got to understand where exactly you can squeeze more margin, where you can improve your cash conversion cycle. And that's where I come in as well. So if you guys need any assistance, feel free to drop us a message. And again, we're going to release a full detailed analysis of this report, right? We're going to go over the financial ratios. We're going to go over the projections. We're going to go over some of the assumptions that we made in this conversation. So if you want to unpack some of those insights and apply them to your case, just wait for the drop and we'll share it with you.
Cool. Perfect.
Any last thoughts, Bepi?
No, that's great, Val. Yeah, I really enjoyed that. And it's really exciting news.
Perfect, guys. Well, stay in touch and follow the deal flow. Perfect.